Alright guys, welcome back to another video. As you can see, I'm using a camera now. I'm going to try to do this in most of my videos just to give it a more personal feel, that sort of stuff. So as you can see today, we're going to talk about why indicators are not good in my opinion, why they're really a trap for new traders. I fell into the trap. I was a new trader at one time, and indicators are made to be very attractive to new traders. They're made to, make trading easier. But I'm here to tell you they do not make trading easier. They make trading much more difficult. And I'm not saying that you can't make money with indicators. You definitely can. There's people that do. Um, what I want to tell you guys is if you simply focus on price and volume and patterns, right? Uh, Areas of imbalance and then areas of balance, right? Consolidation and breakouts. Just focusing on price, that is really the best way to go about it. But I don't want to just tell you guys that. I want to, take you through some commonly used indicators and just explain the weaknesses behind them. Okay. So as you can see, I have a ton of indicators on my chart. I have an Ichimoku indicator. I have some moving averages. I don't know if I threw some Bollinger Bands on there. There might be a different one. I have a RSI. I have a MACD. Those are two very commonly used indicators. They can be used to determine overbought or oversold conditions. People use them to find divergences when the stock is going up and the RSI is making lower highs. People like to say, oh, there's a crash coming, right? So, and I used these. I used these when I started trading for, I don't know, probably a year or so. Uh, I I tried a lot of different indicators. I tried Ichimoku. I tried moving averages. I tried RSIs. I tried the MACD. I tried moving averages. Right. I tried it all. And in the end, right, they are misleading to new traders because it makes you believe that a set of conditions on an indicator is going to lead to price doing something, when in reality, that indicator does not actually tell you anything about what price is currently doing. Um, and so, first of all, if you're going to use any indicators at all, do not have your chart look like this. If you cannot, if you cannot draw anything on your chart and see it, if you zoom in and you can barely see the candles and make out what's actually going on, you have way too many indicators on your chart. Okay, so number one, the first thing that's bad about indicators, they're misleading because they're lagging, right? So they take data from the past and they translate it into a data point. They are a single point in time. A moving average is simply a point right where price is, and it's calculated by the average price from the last however many days. And so a moving average is simply a single point. Imagine this line is not here, and you just have a point. Now, I don't have a huge problem with moving averages because they can be important levels, mainly on daily charts. I like them, daily and longer. Uh, and it's just if you have too many, they're in different places on different time frames. You don't know which one to trust. You can see how it would get very misleading. As far as the RSI and MACD, they are my most hated indicators. Definitely, I like to call the RSI the really shitty indicator because it literally does nothing for you. If you just look at this chart on Apple, I'm going to take the Ichimoku off. I just put that on for kind of a lot of visual clutter. So, okay, here's maybe what someone might be using. Maybe with a VWAP tied in there for day trading or whatever. The problem with this is when you have a strong trend, there's one way you can recognize a strong trend with moving averages is the separation and the steepness of the moving averages. So another reason why moving averages can be good for new traders, it gives you a really clear picture of trend, and it gives you that good idea of where the market might go next. But obviously, nothing's an end all be all. As far as the RSI and MACD, There's a huge problem with them because in the market, there is absolutely no such thing as overbought or oversold. If there's an excess of buyers, if then there's going to be price moving up. If there's an excess of sellers, the price is going to move down. If the RSI is at 100, but there's an excess of sellers, it doesn't matter, right? The RSI means absolutely nothing. So if you, I'm going to take the moving averages off so I can get a clearer picture here of what price is actually doing. If you decide that you don't want to trade Apple because of your RSI or your MACD, right? Let's take a look, right here at this point, right here. The RSI is at the overbought line, while price is consolidating in a sideways manner, preparing to go higher. As Apple breaks out, the RSI is still overbought, right? And not to mention the MACD here is having a crossover. The histogram is turning red. Many traders use this as a bearish symbol that the market is soon going to see a crash or a sell-off, and they may be hesitant to get in. When you look at this chart as a price action trader, you simply look at uptrend, higher highs. What has this done? It's broken the most recent resistance, and it is going sideways in a bull flag or a high base pattern over a resistance level looking to go higher, right? You don't need any indicators to know that. You don't need to be scared off by any indicator that might be showing you a different signal, right? All you're doing is looking at price and what pattern is it making, right? And what important levels is it over or under? We're over an important level. We're moving sideways, and we break out and go higher. All the while, the MACD stays even, right? And then it finally gets a little bump. Is it curling down? Is it going to crash? Right? The MACD looks pretty high. It's about to crash. No, it's simply a pullback that gets bought up. It goes to fill this gap right here. That's what it does, and you see a bullish sentiment. It bounces at the gap, finishes the day above the closing price from the previous day. That's a bullish sign, right? When you see that nice reaction, that's a very bullish sign. You can see Apple goes on to continue making higher highs. As a price action trader, that's exactly what we'd expect. But as someone using an RSI or a MACD, this is a time where you say, oh, it's looking scary up here. I don't want to invest here. I don't want to trade here. This looks really scary. You can use, literally for anything in this bullish run we've had, you can make the same case, right? Tesla is a very, very good example. And Tesla, it gapped up after its earnings, and right, you see the MACD curling and cross. But how far did Tesla come, right? How far did Tesla come? Okay, it came down 8%. That's fine. That's well and fine. But what does that gap up from earnings mean, right? Do we not have, broken trend, right? Look at that. That's not perfect, but do we not have a broken trend line from a downtrend that happened for, the last almost a year? As a price action trader, you're seeing that break of trend, right? You're looking at a break of trend as a bullish signal that the stock is going to reverse. It's more like this, right? And if you have a trend line here too, right, we see, okay, that's where it actually pulled back. And once Tesla broke that trend line, look where the RSI, look where the MACD is, right? I'm sure if you had some Bollinger Bands, it would be up at the top of them, right? Let's put those on. Let's look at Bollinger Bands. Here's the orange line is your Bollinger Band, right? So you have, boom, you're above the Bollinger Band, right? That's where you're supposed to reject, right? But that's just not the case, because Tesla is one of the most shorted stocks, and when earnings had that gap up and then trend broke, you had an incredible amount of shorts covering as well as buyers. And you have people that are in this for the long term, right? They're not planning to just drop all their shares at the top. They're holding this, right? They're holding this for their whole life, most likely, or at least for a longer period of time. And when you know that, when you know that about a company or about a stock, indicators don't matter, right? You need to focus on where's the excess of buyers. Is there going to be a short squeeze? Not what is your indicator saying? Where is your indicator at? Because that actually has nothing to do with where price is going to go. Okay. If we go back, let's take these off. Let's take these off. And then let's just go look at the broad market. One last example. Let's go to a daily here. Okay, so look at how far the market has come in the past 3 or so months. And look where the RSI has been. Look where the MACD has been starting to curl over, right? Starting to go bearish. But it's so incredibly misleading because all I need to see as a price action trader is one simple thing: resistance, 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 resistance. Is that not? Is this level not like a 2-year long? Sorry, not 2 years. Yeah, it's about a year-long resistance. So the market has struggled to get over a certain zone for a whole entire year. When the market breaks that zone, that is going to cause an excess of buyers that puts us into a bull market run, right? When you look at long-term charts like this is how bull markets begin, or a bull market run begins. This may not be considered the start of a bull market. I don't know how long this is going to go on. But I'll tell you one thing, it's definitely not done yet, right? And okay, you have there's many traders that will look at this and be like, oh, look at the RSI, it's making lower highs, right? And it's at the trend line. Are we about to crash? Right? Should I sell all my stocks? Hell no, right? Look at where we're at. Look at where we're at, right? Any pullback that the market has is going to be bought up. I'll send each one of you $20 if it doesn't, because I'm that positive. Why? Because I don't use these shitty indicators, right? And again, I'm not saying you can't use them, right? If you can make money using them and you have your own strategy, that's totally fine. That's great. Props to you. I met a trader on Discord that was friends with many professional traders, and he introduced me to price action trading. And I was really willing to learn when I started trading. I really liked it, and I wanted to be the best I could. I wanted to use the best strategies, and that's kind of what the goal is in the beginning is to use the best strategy, right? You're all focused on different strategies, and then you later realize that it's more about psychology than anything, but I won't get into that. Long story short, I took his advice, right? I took all the indicators off my chart. I went and had a couple one-on-one video sessions with him, and I really learned what to look for in terms of price. Just simply price, volume, and nothing misleading me that is lagging, right? You're looking at a drop in the market, and 2 days later, that indicator is giving you some sort of signal about that drop. But what you should be looking at is, where is price now? Is it at an important level? Is volume coming in at that important level? Is there follow through afterwards? Can you take a trade on it? And that's one reason I don't mind moving averages. If you're going to use anything, throw some moving averages on, throw a 50 period and maybe a 200, right? You only really need 2. If you want 3, maybe throw in a 100 period. But you really only need a 50 and a 200, in my opinion. Those are the important moving averages. There are definitely institutional traders that look at those, but yeah, I mean, everything else is just so incredibly misleading, and I'm sure you guys have experienced that. Your trade will work one time when you base it off a set of indicators, and the next time it's like, what happened, right? My indicator gave me this signal, and it didn't work out, and that's trading. Nothing is ever 100%. But if you want the highest probability trades, what you need to focus on, one last time: price, volume. Third, relative strength or relative weakness. When the market is going one direction, or when a sector is going one direction, if a sector is breaking out, if a sector is breaking down, then go into that sector, find stocks in that sector that are either breaking up with the sector, showing relative strength, or breaking down, showing relative weakness, that will likely move with that market the most. That's all you have to do, right? And I encourage you guys to go learn more about price action trading if you're not really familiar with it. Learn about non-indicator trading, learn about trading relative strength and weakness. In the end, it's going to be harder. It's going to take longer to learn because it's not right in front of you, right? It's not right in front of you showing you a plot of something. It's not right in front of you giving a hint on what might happen. But when you learn how to read price in the correct way, you will get better as a trader. I guarantee you. After you put in that work, trading's, you need an education like any other profession. So when you put in that work, you're going to be glad you did. Let's just say that, right? You're going to be very glad you did. So that's going to be it. Hopefully you guys found this helpful. I tried my best to explain, why they're really not good to use. And yeah, best of luck to you guys in your trading journey. And I'll see you guys in the next one. Peace.